people may still want to have a risk-focused approach to equity investing. So we think the equity market still looks strong, but we're here to talk in part about dividend strategies. And dividends, of course, because those companies are paying out a dividend on a regular basis, they provide a bit of a cushion, downside protection, and companies that are paying and growing those dividends on a regular basis, you can have more confidence that they're going to pay those dividends in the future. That can be a fundamental strength for many investors.
So when you saw this morning, I mean, if you're suggesting dividend ETFs, it's because ultimately you get paid to wait, but also you would think that they are going to gain. They're not shorting the market.
Right.
Folks who were shorting the market this morning were pretty happy, but everybody else with 401ks and IRAs don't want to wake up and see the market down 500 points on the Dow. And then you had someone like Tom Lee come out and say it was a buying opportunity and that it was an overreaction. Were you thinking much of the same when we see the dips? Is that a buying opportunity?
Well, it's proven so far that way. The market sold off more at the open and it's bounced back. And so, yes, those dividend strategies can give you the opportunity to participate in some of the upside, but with some downside protection. And so there's a number of different ways to get dividend exposure. There's higher dividend yielding strategy ETFs. So Vanguard High Dividend ETF, VYM, is one of those large examples, focuses on the dividend yield for investors and in building portfolios. SDOG, which is an ALPS sector dividend ETF, that's more diversified across all of the sectors, the 5 largest or highest dividend yielding stocks in each of those. And then we also saw Franklin Templeton launch a new ETF a couple of weeks ago that VettaFi is the index provider behind. That gives you some dividend exposure, but a more 2.0 version, a smarter version to get higher dividend yielding stocks. And then, of course, there are those actively managed ETFs.
How about, okay, so which ones are you going to focus on when you talk about the actively managed ETFs?
So we've got firms like T. Rowe Price with their dividend growth ETF. TDVG is a great example of that. You get the benefits of active management in building the portfolio, looking at the valuation, but it's more forward-looking in terms of dividend construction as opposed to the backward-looking, looking at historical dividend growth. So we think that's a firm to make note of. Federated recently launched a little while ago a dividend ETF that we think is worth paying attention to as well. Some of those leading asset managers now have an active dividend presence, not just a mutual fund presence, but an ETF presence.
I love, people love companies that are the dividend aristocrats. 25 years of the dividends, raising dividends. It's a special group of names, right? Very notable companies. So the ProShares S&P 500 Dividend Aristocrats, tell me about that ETF.
Right, so NOBL is the ticker on that one. You're right, it looks at companies that are in the S&P 500 with a very long track record of raising dividends, so 25 plus years. So you're going to get a more defensive oriented portfolio, a lot less exposure to technology. There aren't many technology companies that have either been around for 25 years,
right,
let alone paid a dividend, whereas VIG, the Vanguard Dividend Appreciation ETF, focuses on the last 10 years. And the Vanguard product actually got a fee cut. So Vanguard has been using its scale to bring down fees today on a number of different products. That's notable to us at VettaFi.
And Wisdom Tree, highly respected. Tell me about that one that you have here.
Right, so DGRW, the Wisdom Tree ETF, is a forward-looking index-based approach. So DGRW looks at companies that are paying a dividend that, according to the index approach, has the ability to raise that dividend going forward. So it's going to have much more exposure towards those technology stocks, the recent dividend payers that are growing it. So this is a yin and yang approach. NOBL is going to look 25 years backward, and DGRW from Wisdom Tree is going to focus on an index-based forward approach.